The accounting equation underpins the entire system of accounting. Now, the accounting equation is assets equals liabilities plus owner's equity. Now, you'll find out that we need to make sure that this equation fits. So, for example, if we have $100,000 in assets, that might be in cash, it might be in supplies, it might be inventory, could be cars and trucks or other equipment. If we have $100,000 in assets, we have to have an equal amount of liabilities and owner's equity. So let's say we have some debts, which are the liabilities. Let's say we have debts of $25,000, which means our owner's equity must be $75,000. So this equation always has to work. So if we have $100,000 on the asset side, we have to have a total of $100,000 between the liabilities and the owner's equity. Another thing that this reveals to us is that if our assets change, our liabilities or owner's equity also has to change. So for example, if we buy a new truck, let's say we bought the truck for $30,000, so we added $30,000 in assets. Well, we also need to somehow change the other side. And that would be, well, let's say we got a loan on the truck for $30,000. So we added a $30,000 liability. So we'll see that when assets are affected, something else also has to be affected. So this is our entire system is made up of this equation. So you have to remember assets equals liabilities plus owner's equity. Now, I do like to break this apart a little bit. Owner's equity is made up of a lot of different things in it. We talked about account types. So assets are things we own, liabilities, things we owe, and owner's equity is it's a bunch of stuff. So that is going to be capital, or that's the owner's investments in the business. So if the owner puts money into the business, it's owner's equity, minus the money that the owner has taken out, which is drawings, plus what we have earned in the business, or revenue, and the resources we have used, the expenses. So we can expand that the owner's equity section to all of these different parts. So what I like to do is I usually like to expand my formula to include those things. So assets equals liabilities. And then I'll say plus capital minus drawings plus revenue minus expenses. I have to keep in mind, though, that this entire thing right here is owner's equity. Okay. So when I'm doing accounts, so if you're like trying to add a new account or something, trying to track something new, you have to place it in one of these account types. So I usually say that's an asset, that's a liability, that's capital, drawings, revenue, or expense. So I do like to expand my formula out a little bit. I'll sometimes combine these two, the capital and drawings, into one. So I will also do assets equals liabilities plus owner's equity plus revenues minus expenses. That's the form that I most often use when I'm talking. So I'll say assets equals liabilities plus owner's equity plus revenues minus expenses, understanding that owner's equity is made up in this version with capital and drawings. So That's the version that I will most often use in this class is I'll say assets equals liabilities plus owner's equity plus revenues minus expenses. We'll also get into a little acronym that I use for that as ALORE, and we'll look at that next chapter. So ALORE, we'll use that next chapter when we're trying to learn some new concepts, and that's an acronym that we will use. All right, so just remember, all of these are the accounting equation. This is not complex math, right? So we're still doing adding and subtracting, not complex math, but this does form the basis for everything that we're going to be doing in this class. So get very familiar with this equation and the implications of the equation. Like if you add an asset, well, you have to add something somewhere else. So that's something else that we will look at this chapter as well, is how do we do transactions and what happens when we have a transaction and how does it affect the accounting equation.